Welcome back. It's time for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back again with Gavin Graham. He's contributing editor at the Income Investor and Internet Wealth Builder newsletters, and also, of course, a longtime market professional. Gavin, you want to talk about REITs and some opportunities that you see in some Canadian real estate investment trusts. I think the key word there may be some. They are exposed, of course, to different sectors of the real estate market. But as almost always, REITs and interest rates are very closely tied together. So let's begin with your view on inflation and interest rates. We are indeed seeing inflation come down. The Bank of Canada has said it sees inflation reaching that much heralded 2% target sometime in mid-2025. What do you see, and what are the implications for investors?
Well, I think the most important point, Paul, for investors looking at inflation is it's come down a heck of a lot already. I mean, this time last year, as you'll recall, we were looking at 8.5%, 9% prints, partially because, of course, you'd had the big jump in energy prices, but also you'd had the whole pandemic imposed supply constraints and restrictions. And then the moment that people could actually get out and start buying stuff, demand shot through the roof while supply had been constrained. Now, a lot of those have worked, those factors have worked their way through the system. We're down to around 3%, 3.1, 3.2 or something like that. And it's heading towards the 2% target, although, as you know, the Bank of Canada is only saying mid-2025, not next year. So we still have a ways to go. And quite frankly, I think it's fair to assume that while we may not be back in the 1970s, and I think as Ed Giardini was on this morning saying, we're not going to see the sort of twin spikes we saw in the 1970s, but we are going to see a somewhat higher level of inflation. So maybe we're in a 2 to 4% inflation world rather than a 0 to 2% inflation world, which is not necessarily a bad environment for equities. What it does mean, however, is that it looks like the central banks have finished raising interest rates. The largest and fastest increase in interest rates in the last 40 years since Paul Volcker was breaking the back of inflation in the early 1980s. We went from 0.25% to 5 or 5.5%. So firstly, obviously that's been very bad news for interest rate sensitive sectors that are regarded as bond proxies, of which obviously REITs are an element. But the other thing is, of course, we have an inverted yield curve. And while it's taken a while, we are seeing substantial signs of an economic slowdown, which means probably we're going to get, maybe it's the fabled soft landing, but there's going to be an economic slowdown. So you need to be selective in which sectors of the REIT market you're looking. But what we're seeing are some of the biggest discounts to NAVs in sectors like apartments or grocery-backed retail, which are actually doing pretty well in an operational business and paying you a pretty decent yield.
So talk to us more about the sectors you like and the sectors you don't like. The hardest hit sector, without much doubt, is the office sector, where there's all types of gloom. Would you avoid the office REITs?
Absolutely. Although there are one or two, like, for example, Allied Properties, where operationally they're doing okay, and Allied sold its data center business for more than the valuation in its balance sheet. But the market doesn't care about that, because you've had people like Slate Office and True North not merely cutting, but suspending their distributions. So the risk is too high. So leave that to one side. And general retail is probably not especially attractive. Although, for example, Primaris, the enclosed retail mall operator in secondary centres, just did that big deal in Halifax last week and another one in Waterloo earlier this year, because it's operationally doing pretty well, thank you. And so they're, even in the general retail space, but the grocery anchored retail REITs, things like Choice or CT REIT or Crombie, they're off 10 to 18% this year, yet operationally they're doing very well, and you're getting a 6-7% yield out of them. So they look attractive. They've been through the toughest tests you could possibly have with the pandemic in terms of the restriction of people's ability to go out and shop, but they're necessity-based retailers or groceries has been very resilient. The other area, obviously, is apartments, because we continue to have mass inflows in terms of immigration. There aren't enough places for them to go. So the apartment REITs, things like Canadian Apartment or Boardwalk or Interrent or Minto, have all actually held up much better than the sector as a whole. In fact, some of them are like, I think Bulwark's up 30%, which reflects the strength of the Alberta economy and the fact that Calgary and Edmonton are still pretty reasonable places to rent. But the others, particularly with the exposure in Eastern Canada, are also doing very well too. The yields aren't as high, but the underlying demographics look really good for this particular portion of the REIT market.
So you like the segments of the REIT market in which ultimately consumers or renters are spending on things they must spend on. Groceries, of course, are a consumer staple. Housing is housing. Explain to us, Gavin, remind us, I guess it might be a better word, the relationship between the grocery REITs and the operating business of a grocery. Choice REIT is related to the Loblaw companies, and Crombie REIT is related to the Empire, i.e. Sobeys, Safeway companies. Yep. Draw the link between the real estate investment trust, which is a real estate vehicle collecting rent on a property, and the underlying business, which is selling groceries.
Well, in essence, it's a sort of mutually beneficial arrangement whereby the landlord of the grocery stores, or in the case of, say, Canadian Tire, the general purpose retailer, is also owned by the same company. So that means you have no likelihood of a major tenant going and departing, as happened, for example, with, say, the close down of Target or Sears for the more general retailing sector. You will generally have an arrangement whereby if the operating company wants to, it can actually sell some more of its grocery stores to the REIT, which means there's some growth from that. There will be inflation-linked increases in the underlying rent. I think Canadian Tire, for example, has a triple net lease where, in essence, the tenant covers virtually all of the expenses. The major factor is it's a mutually beneficial arrangement whereby you have the same party owning both. The market rents are in line. They are going to go up, not maybe in line with inflation, given how high inflation has been the last couple of years, but there will still be some growth in that underlying rent. And as you remarked, people have to keep buying groceries or pharmaceuticals, or in some cases liquor. So you have a very resilient sort of demand stream. Maybe people are trading down within the basket they're buying, and we know that there's been some concern on the part of government about the high prices, but as the grocery operators point out, their profit margins, and you can do the numbers on their publicly quoted accounts, they're maybe making 2.5% to 3% margins. So it's not exactly as if there's an enormous amount of price gouging, even though sometimes the cost of things in the supermarkets can be a little bit of a shock.